Hello and welcome to Super Insider, where we chat about what you need to know to make the most out of your super. I'm Anne Fuchs and I'm the Executive General Manager of Advice, Guidance and Education at Australian Retirement Trust. Before we begin the show today, I'd like to acknowledge the traditional owners of the land and waters that this podcast is recorded on. And just a reminder that what we discuss today is general advice only, so you will need to decide if it's right for you. Today, we've got another installment of our Q&A series, and these episodes are where we answer the most asked questions we get about superannuation, retirement, financial advice, all sorts of topics. Why? So we can help you grow your superannuation knowledge and give you practical tips and tricks to help you retire well with confidence. In today's episode, we've got Ruth Weaver and Stephen Fehring from our member education team, and we're going to answer some of the most frequently asked questions we get about how to fund your lifestyle in retirement. So without further ado, please welcome Ruth and Stephen.
Thanks, Anne. Ruth and Stephen here from Arts Education Team. And today we're going to talk to you about some frequently asked questions we get from individuals who are getting close to retirement and looking forward to finally starting to access that superannuation that they've worked very hard to accumulate. Now, Stephen, I think we'll start at the very beginning and we'll explain to our audience what is an income or a pension account when it comes to accessing super?
Yeah, definitely. So within superannuation, we use a lot of names for a lot of things. And usually when we say super, we mean accumulation phase. But eventually you get to retire, you get to spend your money. And we call that a few different things. So you might hear it called an income stream, an income account, and a pension, an account-based pension, a retirement account, or a retirement pension. They all generally mean the same thing. And today that's what we're going to be referring to as an income account. It means that you've taken your money inside of superannuation and you've decided to pay yourself. Now, it's very different to the Centrelink age pension, which a lot of people get confused with and mixed up with. But essentially, you're paying yourself with your own money, and it's quite flexible how you do that.
Yeah, and I think for a lot of people as well, we get asked, how is it different to a superannuation account? And it's important for people to recognise that an income stream or a pension account for your superannuation looks and feels very much like your superannuation account did. You have very often access to the exact same investment options, but one of the key differences is the fact that your investment earnings are tax-free once you've retired and you're using an income stream product. Now, if you're still working and you're accessing money through a transition to retirement, that's not the case. But generally where you're retired, you know, the account is going to look and feel very similar. Tax-free earnings on your investment options. And it's really a design where it's a one-way stream. Money is actually coming out of the income stream account or the income product as opposed to like your superannuation where money is generally going into the account. So if we want to sort of have a little think about the logistics of how does an income account work, if you think of it from the context of moving your money out of a superannuation account into an account that's going to look and feel very much like your superannuation did. You'll have access to the same investment options, for example. But the difference here is you're going to be telling the super fund how much money you want to draw from the account. You'll also be telling the super fund how often you would like them to pay you that money. So you might nominate to be paid monthly, for example, in line with your current income. And the other thing is to be mindful of is you don't need to move all of your superannuation money into the income account. You can select an amount. Now, there will be minimum amounts, for example, and maximum amounts, which we'll cover shortly. But just to be mindful of the fact that logistically, the process of moving your funds from your superannuation account into an income account to get funds paid into your bank account on a regular basis is a very, very simple one.
Yeah, people often have it confused. They think they can only have one or the other. So they think they can only have a superannuation income stream and they can't get the age pension. But they often work together. And like you've said before, there's many different ways that a pensioner or someone can get income in retirement as well. With the income account, you have to be usually, well, generally speaking, you're 60 years of age when you open one up. You get to choose how you're invested. There's a minimum amount that you must draw down. But you get to choose how often or how much above that you actually get paid. Now, there are other sources of income as well. So what sort of sources of income do you think someone else might be looking at?
Look, I think when we're talking to individuals in particular, people are trying to manage various different sources. I think the most common ones will be, how will I structure this income stream payment in line with my age pension? And maybe there's also income coming into the household from another asset, like an investment property, for example. And I think when we try and think back about the process of, well, how do I work out how to get it out? Is it better to take it out in, irregular lump sums and manage it through the bank account? I think the best thing for people to do is to contact their own superannuation fund, find out what the payment options they have. Some funds will offer fortnightly payments, some monthly. You can even do quarterly, and in some cases you can do biannually and even an annual payment. So just give your fund a call and find out what options you've got available to start drawing your money from. Another question that comes up an awful lot as well is, how much do I have to take out? So if I do move the money across, am I obliged to take money out? Is there minimums or maximums? That is a common question, particularly for people who are trying to work this particular flow of income in line with other income flows that they might have coming through to the household.
Yeah, and this is a tricky one because the minimum amount actually changes over time. So between your preservation age and your 65th birthday, it's 4%. And that 4% is just the minimum. It's not the recommended amount. It's not necessarily the amount that you should draw out. But 4% is the minimum that someone between preservation age and age 65 would withdraw. And it gradually goes higher above that. And there's lots of information you can find this, like on the Money Smart website or your super fund's website. They should have a criteria and show you exactly what your minimum drawdown is. But that said, minimum drawdown isn't a guideline. It's just the legal minimum that you must take out of your income account.
That's true. And I love the fact that when we're talking to individuals about the minimum drawdown, we can very quickly follow it up by saying, the good news is, though, there's no maximum drawdown. So you are required to take a minimum amount, but you're not capped at all on how much you actually do draw down.
I will call you out there. Maximum is 100%. You can't take more than that, unfortunately. A great 1 year in retirement, though, should you do that.
Great. Yeah. Go out with a bang at the beginning. Now, look, at a question that we get asked an awful lot. It's a really difficult one to answer. In fact, I would say it's impossible to answer. But it is very much around, how long is this going to last me? And it's almost like asking how long is a piece of string. It's going to depend on so many different factors for households. And I think if I was to think about it as practically as I can, it will depend on things like, well, what is the lifestyle you're trying to live? So how much are you going to be drawing out of it on a regular basis? How are you going to invest that? Because you will be relying on investment earnings to fund a lot of the money that you're drawing out of the account. So to try and protect some of the capital, if you like. It will depend on how long you're in retirement. So obviously the younger you are at retiring, the more money you're going to need to fund that. It can also depend on personal circumstances in the household, whether or not you've got a spouse who's also got superannuation that they're drawing, and it takes pressure off you on how much you need to draw down. And of course, if there's income coming from other sources, it means you don't have to draw as much from superannuation as well. There's lots of brilliant tools out there. On most superannuation funds have retirement calculators. I would suggest you hop onto your fund's website, use their retirement calculator, and whilst it won't be exactly like science and tell you exactly the day your funds will run out, because it will depend on various different assumptions, it's going to give you a really good starting point, giving you an indication of what you can but also what you cannot do during retirement. But I think going back to the product itself on drawing down the income, we do get asked, well, what's the difference then? What's the advantages of moving my money into the income stream versus just leaving it in superannuation?
Yeah, I mean, that is a common thing we have when people retire. They just don't know what to do, who to trust, where to go. And obviously your super fund's there to help you with that. But if you were to leave it in accumulation phase, there are a few things that you would miss out versus being in income phase. Now, income phase, some of the benefits is that the investment returns are now tax-free. So just imagine if you made $10,000 return, in accumulation phase, up to 15% of that would go to the ATO, whereas all of that stays in your income account and can pay you an income. So the government has designed superannuation basically to pay you as much money tax-free as possible because they want you to fund your own retirement. So a huge advantage there of that tax-free income. Also, once you're over 60 years of age, anything you withdraw from superannuation is not assessed for income tax purposes. Now, a great thing as well is a lot of super funds offer what's called a retirement bonus. So they want you to go from accumulation phase to income phase, and they're actually able to give you a bonus for doing so because they've reduced their tax liability because of that 15 cents in the dollar that you get taxed in accumulation phase. They no longer have to pay that. So you get some sort of bonus going from accumulation phase to retirement phase. So just check with your super fund what sort of amount that they offer, and you'll be quite surprised. Extra little few dollars in your kitty.
Now, I think the next question we get is, am I eligible to open up one of these accounts, or who can do it? And realistically, it's very much an age-based system. The rules are very dependent on what age you are. And once you've reached what we call preservation age, and preservation age, for anyone listening, is basically the legal age at which you can now consider accessing your superannuation. And for the majority of us, that's going to be age 60. So once you've reached preservation age, you're able to consider accessing super in some capacity. Now, if you are still working, there is an option called a transition to retirement. We do have a podcast on that if you want to go back and listen and learn a little bit more about how that works. But for those who are retired after the age of 60, you absolutely can use one of these products. Now, an unknown fact here is if you are 65 and you're actually still working, you can use one regardless of whether you're working or not. So you've got full tax-free access to that superannuation once you're 65, regardless of your work status. So it is something that a lot of people aren't aware of, that you don't have to wait for pension age to start accessing superannuation. The windows will start to open a little bit earlier than that. Another question that we do get an awful lot as well is, what if I move my money into this income stream and then circumstances change and then I don't want to access it anymore, or I want to put money back? What is the process for people to think about if they've changed their mind?
Yeah, this is one of the good things about the retirement income accounts is that they have a lot of flexibility. So should you not need that money paid to you anymore, you can roll it back to accumulation phase, you can withdraw it all, you can do whatever you want essentially. They're quite flexible accounts. So you can dial out that income up and down if you need. You could even change to an annual payment and not get paid till June. So there's a lot of things that you can do with these income accounts because they are fully flexible within the product's rules.
Yeah, I think another interesting thing is a question we get asked about, can I have a joint income account? And just to put our audience at ease here, you can't have a joint income account, but you can both have income accounts under the same superannuation fund, but they can't be in a joint name. Remember, with the income stream accounts, you can't get money into them directly. So sometimes we'll field lots of questions about maybe an inheritance that came through, maybe you're downsizing the property and you want to take advantage of the downsizing rule. If I can put it to you this way, an income account is one-way traffic. Money can only come out of the income account. And that's the reason why sometimes, like Stephen said, you might want to revert your income account back to a superannuation account, or you might decide to leave a small amount in your superannuation account as well if you are sort of thinking that there may be money coming your way over the next couple of years and superannuation is where you want that money to end up.
Yeah, I think it's important for listeners to understand that any money that is outside of superannuation, the first port of call must be an accumulation account.
Yeah.
There's no option to put it anywhere other than an accumulation account. Within a day, it can go to another account, but accumulation account is obviously the first port of call for any non-superannuation money.
That's where the journey begins, in the accumulation stage, and you can move it over to that income stream stage once you're eligible under that age criteria we talked about. The next question that comes through quite a lot as well is, and we've already touched on this quite a bit, is when can I open an income account? So at what point can I start to talk about this?
Yeah, you can open it up any time. Now, people obviously think financial years.
Yeah.
It doesn't matter. You can open it up in January. You can open it up in May. It really doesn't matter. You can open up whenever you're eligible to open the account. What's important though is that minimum payment is prorated in the first year. Now, should you open up an income account during the middle of the year, it's actually prorated the minimum amount that you must withdraw. Now, there is different age-based minimums that you actually withdraw out. So if you were to open it up at the very beginning of the financial year, because it is based on financial years on 1 July, you must take out that full minimum over that entire financial year. Should you open up halfway through the year on 1 January, for example, you'd only have to take out half of that minimum payment because it's prorated for you. So a huge advantage there. I
think as well, a common question that comes through for us is, which what kind of different income accounts can I have? How do I compare? My money might be in one particular fund. I've also got an account in another fund. I want to bring it all together. Which one should I use for my income stream? And it's just about reminding people as well. There can be differences, and you certainly can compare some of the features of an income account. And a lot of the comparative points when you're comparing these products are not that dissimilar to how you would actually compare an accumulation account or your superannuation account during working life. You would be looking at things like the fees associated, the investment earnings that the fund has been able to generate. But what other kind of comparative points might someone need to think about if they're looking across funds?
Yeah, you're right. It is very similar to accumulation phase where it's very hard to compare them equally as well because a lot of stuff is variable. So fees are generally fixed, but investment options, generally you can choose the exact same investment options in income phase. Insurances generally aren't allowed in income phase as well. So there's lots of things to consider. I guess it's just a matter of making sure you're comparing apples to apples. So if you're looking at your account in cash and you're looking at another account in aggressive, so they're going to have very different returns and very different investment fees. So just make sure when you're comparing your funds that you've got very similar products there and you can see which one's right for you. But it really comes down for a lot of people convenience. So being able to access the app, being familiar with the way the website works, making sure that you're with someone that you trust as well.
Yeah, that's a good point there that you make about the app. So looking at things like the flexibility of being able to change the frequency of your payments, particularly if you're traveling and it's not always easy for you to get on the phone and talk to your superannuation fund, what kind of facilities do they have for you to be able to self-serve, for you to be able to maybe change the frequency of your payment, change the amount of your payment, or even take a lump sum out of that income stream as well. And that's something that we haven't really discussed yet, but the fact that the income stream product is so flexible, you are also able at any point to take an additional lump sum out of that particular account as well as the regular flow of income that you've got.
Yeah, spot on. You'd hate to be stuck in the nullarbor trying to pull out $10,000 out of your account, using a form and doing ID. Like that'd be very difficult to do.
Yeah, trying to rely on the snail mail to get that form into the fund. Look, there is some questions that often get fielded as well about, look, this is my particular balance. Do I have enough to start an income account? What are the criteria here? But different funds can have rules as well around how much is needed to come out of the superannuation account. Now, I mentioned you don't have to use all of your superannuation to open the income account. You might want to leave some in super and just move a portion of it, particularly because you do have to take a minimum amount out. That being said, there can often be a minimum balance that has to go across into that particular environment, and that can be very super fund specific. But there's also maximums to be mindful of, isn't there?
Yeah, that's right. So there's a legislative maximum of up to $1.9 million. It's in the current 23-24 financial year. Now, it used to be a $1.6 million maximum, and that has gone up over time. But funds usually have their own minimum balance, so a lot it's around the $20,000 to $50,000 mark. That's what they make you put into an income account to start with.
A question that gets asked a lot as well, and I've fielded this quite a few times, particularly during retirement webinars and retirement seminars, is just picking up on the minimum drawdown amount. So the government have put minimum amounts that you must take out of the income account, and as Stephen has already said, it starts to increase as you get a little bit older. But what they haven't done is put a maximum on there, and it's just important to remind our audience that there is no maximum on what you draw out of the income account. So if you want to live it up for the first 3 or 4 years and go travel the world, you're not restricted in how much money you take out of that particular income account. It's very much up to yourself. Most of us have a concern in retirement about longevity. We are worried that our money will run out before we've passed away. So we're a little bit scared to go too excited in the early years with superannuation. But it is just reminding you that it is very flexible and you're not limited. And when I talk about not limited on what you're taking out, I'm also referring here to the ability to withdraw the lump sums from that particular product. There is no limit on how much comes out of the income account. The final question that we get is, what if I have buyer's remorse here? What happens if I've opened up this income stream account or this income product and then my spouse goes back to work and suddenly there's a new flow of income coming through? I don't really need the money anymore, or I've come into a windfall. what can happen, or how does somebody go about reversing it? And you've already touched on it, but just give us a bit more on the logisticals around how that works.
I mean, there's obviously a lot of options here, and advice is a good idea to have a chat with someone just to work out that it makes actual sense for you. But you could close that account up, put it all back into accumulation phase. You could choose to get paid later in the financial year, or you could even choose to take that money out and then just pay it straight back into superannuation, into your accumulation account. So there's a lot of reasons why you might do all of these things. There's a whole heap of strategies here, and it really just depends on what's right for you. So you need to get all the full context as to why you're wanting to close this account and where the extra funds are coming from. So then someone can work out basically the way that you can keep as much money as possible, which is obviously your goal, boosting your super, but still making sure you get any advantages that are available to you that you may not be aware of at this stage of your life.
Yeah. So I think it's just about reminding people that, you know, nothing is for life in here. This income account is reversible. You don't have to be too concerned if your circumstances changes. We can change it back so that it suits you. So finally, how to open an actual account. If you're somebody that's very confident in your situation, you're well read on this, you're well versed, you feel confident to make your own decisions on how much you want to draw down, how frequently you want to draw it, you're well versed on how you want to invest that particular money, opening the account is actually really easy. There's a couple of channels I'd suggest. Number one, if you're registered for online access with your super fund, most funds will actually allow you to open one of these accounts online. So that's how simple it can be. Now, there will be things that you've got to verify, your identity, for example, and the bank account that you want to get paid into will have to also be verified. But technically, it is something that you can self-serve on if you want to, and you want to go and open it up yourself, or give your super fund a call. Very often the individuals in that contact centre can help you open up the account over the phone in often cases, or maybe you just like the old school pen and paper and you want to fill out the application form and post it into the super fund or email it to the fund, and that of course is another option, isn't it? So there's lots of ways that people can actually get one of these off the ground.
Absolutely. Like, I helped my mum open up her income account. It took us 3 minutes to do online, but if you just give us a call, we'll talk you through it and it'll be quite simple.
And finally, before we wrap up, I've said that a few times now, but I think I'm finally at the end. Before we wrap up, the next steps, where to from here. So if you've listened to this and you think, yep, this is me, I want to open up one of those products, I would rather do it this way or that way, I think keep reading, keep asking questions. As Stephen said, you know, reach out and get advice. Talk to your super fund first and foremost. Many superannuation funds might have advice options for you to tap into, and a lot of the contact centre people will be able to answer most of those general type questions that you've got anyway. There are lots and lots of different tools available on websites. Hop onto ours if you want. We have some wonderful tools, the Retirement Forecaster, lots of different educational videos on there for people to learn a little bit more about super, and most importantly, about spending it. Thanks for joining me today, Stephen.
Thank you, Ruth. Pleasure being here.
So listeners, I hope you found today's episode useful. We've got some more Q&A sessions coming up, so if you do have any questions, we'd love to answer them. Please send us an email at podcast@art.com.au. That's podcast@art.com.au. Thank you so much for listening to Super Insider, and we hope you can join us again next time.